Today we're going to calculate the net present value, part 1 of 3.
As is my usual practice, off camera, I've set up the spreadsheet you see in front of you. And so here's the scenario. You're going to make a $100,000 investment in an asset in your business. You're going to spend $100,000 buying a new piece of equipment or doing some new thing in your business, a new assembly line. Maybe it's a new tractor. And as a result of that $100,000 investment, you're going to be able to increase your cash flow, extra revenue coming in minus cash expenses going out by $15,000 a year. And this is just an example I made up. That asset's going to last you 10 years. And at the end of those 10 years, you're going to turn around and sell that asset for $10,000. So in the last year, you're going to have an additional $10,000 of cash flow on top of that $15,000 worth of cash flow. And the question for you to ask is this a good idea? Is this a good investment for your business? A better question would be to ask, is it the best possible investment for your business? And we're going to be getting to that later, but for now, I want to show you 3 methods that you can use to determine if it's a good idea. The first method is called the payback method. And the payback method is just simply trying to figure out how many years it's going to take before you will get your initial investment back. How long does it take to pay yourself back? So we type an equal sign and we click on the $100,000 investment, the amount of money that you're going to spend on the asset. You're going to divide that by the $15,000 annual cash flow, and we press enter. So in this case, I just typed an equal sign, clicked on cell B2 where my $100,000 was hiding out, then hit the type of slash to divide, and clicked on cell B3 where my $15,000 annual cash flow is hanging out, and I press enter, and we get a number. We get 6.67. So basically what this is telling us, let me format that to 2 decimal places just because I like 2 decimal places better. What this is telling us is that it will take you 6 2/3 years to pay yourself back, meaning you're going to be paying for this asset, right, for the first 7 years. And after that, any revenue that you make off this asset, it's just going to be profit, is the way to think about it. So it takes 6 2/3, almost 7 years to get your money back out of this investment. So now, is that a good thing or a bad thing? I don't know. There may be investments that take longer to get your money back. There may be investments that get your money back quicker, but it's a way of getting a handle on, is it a good investment or not? Now, another thing we can do is called the simple rate of return. We type an equal sign, click on the $15,000 annual cash flow, because that's going to be the annual return from this investment. Type a slash to divide, and then click on the 100,000. As you can see, these 2 things are just inverses of each other, and we get a number. I've already pre-formatted that cell so it pops up as a percent. So the way you want to think about this is this investment is going to turn you 15% return every year using a simple rate of return. Which, that sounds pretty good. I don't know if you can get 15% on your money in any other investment. And so those are 2 really simple, just by dividing, methods that you can use to figure out if this investment is a good idea, if buying this piece of equipment for your business makes sense. Now, the problem with that is that it doesn't take into account some other really important factors that you need to be considering, such as the cost of capital. The cost of capital is just a way of coming up with a benchmark. What return do you need to get in order to make this investment worthwhile? Because the reality of it is, in order to buy this $100,000 asset, you're going to have to borrow the money at some interest rate, or you're going to have to get that money from some investor who's going to insist on some rate of return for their investment, or you've got to pull that money out of your own cash reserves, money that could be earning interest somewhere else. In another video, I will talk about how we come up with this concept of cost of capital. But for now, let's just imagine that there is a cost of capital, and that cost of capital can be thought of as a depreciation, can be thought of as a discount rate. So what I want to do here is I want to add a discount rate to our formula. And I want to just take these three cells here, these 6 cells, and just move them down one so they're separate from each other. And let's plug in a discount rate of 8%, just so we can have a number to work with. I have no idea if that's a fair or accurate cost of capital, but we're gonna use it for an example. And we can always change it. That's the beauty of doing this in a spreadsheet. You can update and change things. What we're going to do now is we're going to calculate the net present value. So the net present value is equal to the present value of the income stream, right? So you're going to add all the positives and subtract all the negatives, and you're going to calculate the present value of this stream of future income. And this stream of future income, if you've been following along with my videos, you're going to immediately recognize that $15,000 a year every year for 10 years is basically an annuity. So I'm going to hit an equal sign, and I'm going to type FV. No, I'm going to type PV. Sorry about that, because I'm trying to find the present value. And I'm going to do an open parentheses, and I'm going to click on the rate that I'm using, which is the discount rate. I'm going to click on top of comma, and then click on the number of periods, which is 10 years, hiding out in cell B4. And then I'm going to type a comma, and I'm going to click on the payment. So the payment is $15,000. Now remember the cash flow concept for these formulas. So I'm going to put a negative sign in front of this so I can make sure that I get a positive number when I'm done. So I'm going to get a $15,000 payment there in cell B3 every year for 10 years. And then I'm going to type a comma, and then in that last year, I'm going to get an additional $10,000 payment. I'm going to put that into the future value argument. So I'm going to type a negative sign. I'm going to click on the 10,000. I'm going to close that parenthesis. And what we find is $105,283.16. But that is only the net present value of the positive cash flows. This doesn't take into account my $100,000 investment. So I click on my formula again, and I double click to edit the formula, and I just move the cursor to the end. I type a minus so I can subtract, and then I click on my $100,000 investment. Now, if you read a textbook, it's going to say you've got to do the present value of any negative cash flows. The investment happens up front. The investment happens in time period 0, whereas your cash flows start happening in time period 1 through 10. So I could calculate the present value of this. I'd have to enter the number of periods as 0, and when I'm done with that, I'm going to actually get the $100,000 expense that I had flow out initially. So I'm just going to shortcut that. I'm just going to subtract the upfront expense. And I hit enter, and this gives me a net present value of $5,283.16. Now comes the important part of this. First of all, the net present value is going to be a function of this discount rate. If I have a higher discount rate, the net present value falls. So if I had a 10% net present value, a 10% discount rate, I would actually have a negative net present value. Basically, the way to think about this, if I had to borrow money at 10% in order to pull this off, this is a bad deal for me. But if I have a cost of capital that's much lower, say 5%, then it actually starts to make sense. So if I have cheap access to capital, then the net present value is higher. And the reason why that is because this net present value is more of a question of how did I do at beating a benchmark, and that benchmark is my discount rate, my cost of capital. So if I've got an 8% cost of capital, it's not that I didn't make a lot of money, it's that I beat an 8% target return by $5,200. So if I have a positive net present value, it means I did a better job than my minimum required benchmark, which is where I get my cost of capital number. So that's 3 relatively quick and easy ways in Excel that you can calculate some numbers to give you some metrics to tell you if making an investment is a good idea. Now this is just like page 1 of a textbook on capital budgeting. There's a whole lot more that goes into this, but this is our starting point, our jumping off point, our first introduction. And in subsequent videos, I'm going to show you some more complicated situations that are going to require more complicated analysis. I'm also going to show you some pitfalls of the net present value formula. Excel, for example, has a built-in net present value formula that you can use. And you have to be very careful what you put into that formula, because if you put the inputs in wrong, you get bad outputs, garbage in, garbage out. So please stay tuned for more of those videos. And as always, if you know of a better way to do this, hey, tell me about it in the comments. I'd like to hear about it.